Good morning, everyone. Today is, let me take a quick look, 9/17. And I want to highlight something that I found very, very interesting. So this chart might be a little convoluted, but I've highlighted a couple of areas here in red. And particularly what I'm looking for is on the consumer engagement custom index that I use. I'm watching these downturns like we have right here, here, and these double downturns here in 2021 and 2022, as well as this downturn back here in 2008, 2009. And I'm paying attention to how the consumer index rolled higher while we saw some upward movement, particularly in the technology index and the large cap index. Notice how the consumer engagement index rolled a bit higher here. Consumers started buying into the bottom and becoming more active in 2009 based on this chart. Remember, this is just data. And we saw the same thing here. Consumers began to get more active, and then we got the bottom here, and they began to get more active right after the COVID low. And we've seen this bottom here in the consumer engagement index, and they've started to become more active. And we're seeing essentially a double bottom in the QQQ, setting up what may become an excellent buying opportunity. We're not seeing any strong upward movement in the technology index. It's flattening out, but we're starting to see some upward movement in the large cap index, and particularly during the expansion phases of the consumer engagement index, we've seen relatively strong growth in the QQQ and technology index and large cap index. But notice how we get this initial wave here. We get this buying phase, we get this acceleration, and we get this movement here in the QQQ. Then we get a stalling period. 2015-16 was the elections. Then it continues to climb. Same thing here. We get a rally phase in the SPY. It stalls out 2015-16, then continues to climb. Then after we get this consolidation, this deep bottom, that's typically found by an extended wave of selling here. That's what I've been kind of looking for. This wave didn't show a real extended wave of selling. I mean, it did, and then it started moving back to the upside over here. But we get this extended wave of selling with a fairly substantial 5 to 6% correction, if not more, in the consumer engagement index. That's what we're looking at right here. In this particular case, 2008, 2009, it bottomed way back over here. But we didn't see the market start to move higher, particularly the S&P or the QQQ start to move higher until into January 20th, 2009. My analysis here, ladies and gentlemen, is that we may be very close to an extended, one of the deepest and most extensive price corrections based on this downward sell signal in the consumer engagement index that tells me that we are maybe very, very likely to an extreme bottom here in the QQQ and in the SPY. And what we're looking for is confirmation of an uptrend here in the technology index and or the large cap index, simply because we want to see consumers continue to rally this higher. And that's going to show us that consumers are buying and moving away from deflationary trends. Now, the Fed obviously is going to raise rates. They're going to do what they're going to do. But it looks to me like this could be a very early warning sign that the bottom in the market is near. Now, I'm going to show you something here that also shows the gold trend. So hypothetically, as we get the same type of trigger, this is the same chart, I've just added gold back down here to the bottom. Notice that as we get this trigger, as we see the consumer index continue to climb, we start to see bottoms in the market, as I was mentioning to you, normally very, very close to an ultimate bottom. We start to see some sort of an upward movement, but we're also very, very close to an ultimate bottom in gold. So in almost every instance from 2009, where we saw an extended 6 to 7% contraction in the consumer index. In this case, this is almost a 20% contraction. So it's a very deep contraction. But in almost every case, we see gold is 3 to 4% roughly from a major bottom. So in this case, it was almost right at a sideways consolidation major bottom before gold rallied up to the 2011 highs over here. And you can see this was down at $700-800 an ounce up to $2,000 an ounce, 100%, 140% gain. Back over here, we see gold is bottoming out. We get this rotation in the market. 2014-15, we see consumers start to engage. About a year and a half later, gold bottoms and starts to move higher. We get this deep consolidation here. Consumer engagement re-engages. We see the rally take place here. Gold bottoms out about 3 or 4% right in this area and then starts to move higher. We get COVID. COVID collapses. You can see how it started to move downward right over here. Really, 2018-19 and before the COVID collapse, gold bottomed out and rallied from here. My assumption is this deep selling pressure and new consumer engagement with the support that we're seeing in the SPY and the QQQ may be prompting a major bottom in gold. We may be only 3, 4, 5% away from a massive bottom in gold and may see a 40 to 100% move to the upside again in gold. So understand, this is really showing us two potential triggers. Now, I need to forewarn you that these are early warning triggers. We don't have any confirmation of this move yet. What we do have is a very deep selling pressure in the SPY, moderately deep selling pressure in the QQQ. We're seeing upward movement in the consumer engagement index. We're seeing technology flatten out. We're seeing large cap index move a bit higher and flatten out. The real reality here, ladies and gentlemen, is this could be very, very close to a major bottom in the market. We need to see this scenario with the QQQ and the SPY start to move higher, which would also prompt higher movement here in technology and large cap index. But we would also want to see potentially gold flattening out and bottoming over the next 2 to 4 months. So this may be a very solid early warning trigger for traders to begin to start dabbling back into technology, potentially the SPY, potentially large cap index, Dow Jones, industrial stocks. This may be a very solid trigger. We just need to see some confirmation across this technology index with a little bit move higher and the large cap index with a little bit move higher. And that's going to start to lead me to believe that the consumer engagement index is going to continue to move sideways, kind of like it did back over here. Move sideways, start to build momentum. It's reached its low. And then once we start to see the big acceleration, I would say, above this point, 0.17, maybe 0.165, 175, then we may see a really big acceleration to the upside. Now, let me show you something else. This is the custom gold cycle chart. Even though gold and silver were moderately lower last week, look at this little white bar right over here, holding up above the lows, showing no real signs of contraction. I'm telling you, I think this is a wash-out, fear-based, panic, reactionary type of move in metals. And I think we're going to see a very strong upward trend depending on how the markets react through the next 4 or 5 weeks. I would urge you to, if you're holding metals like I am and holding positions in metals stocks like gold, silver, miners, and what have you, the idea of getting out at this potential risk level is very uncertain to me. I think that we're very, very close to a bottom. I think this is damn close to a solid major bottom in the metals, and this is a washout low. I'll bet you over the next 4 or 5 weeks, we see this rally back up, potentially back up above 410, 405, back over here in this area. I think this is just the beginning of a massive washout pattern in metals. I think the Fed is very likely to have pushed the envelope a bit too far, probably getting there next week. And as I mentioned to you, these other triggers that we're seeing are showing very clearly that the opportunity is setting up. Now, this is a monthly chart, so this could be 4, 5, 6 months away. This is a monthly chart as well. This could be 4, 5, 6 months away. But I'm seeing what I'm seeing in these charts. I'm seeing strength in consumer index. I'm seeing the technology index stall and flatten and show support. And I really think we may be near a very solid move. Now, lastly, I wanted to show you this, which is a basic Elliot wave count for gold. This is on a weekly basis. This is very, very simple. 2015 low here. We have a 1, 2, 3, 4, 5 pattern, followed by an A, B, C correction. Could be the end of a sideways move. We have a very solid pennant formation right across these lows, as you can see. And we're just now below that low. I would draw this from here to here, coming down here. And of course, we have another one from here to here, which I would go across those closing price levels. And basically, ladies and gentlemen, we need to see this level, this horizontal level right over here, reconstruct as a low price for gold. We need to see this reconstruct as a support level for gold. Change that color, purple, and hold up. So again, ladies and gentlemen, we are at a major inflection point. Remember, I told you September 6th through 8th could be a massive inflection point. I think we're seeing a fear-based, panic, almost reactionary type of move take place right now. And given the risk of getting out of my metals positions before the market turns or as the market turns, I'm willing to take a little bit more risk, see what happens over the next couple of weeks. And I would urge you to consider this pattern, this setup right here, as we are deeper into this correction, extremely deep, many months of sideways correction here in the consumer index. Same thing here on the technology index. Same thing here on the large cap index. I'm betting that, well, I will say it this way. My interpretation is the strength that we're getting into this trend right now, while the U.S. SPY and QQQ are holding up near these lows, this presents a very strong opportunity for a little dabbling near these lows. Run fairly tight stops. So if I were to come over here, go to the QQQ, there's our Fibonacci analysis. Here's our analysis here. If you were to consider buying into this level right here, your stop level would likely be at 277 or possibly down here at 268.58. You would have a very low risk trade. Your stop level would have to be below or near this 268, 269 level, giving you the opportunity to see potentially about 8% risk with the potential of a 27 to 28% upside opportunity in the QQQ. If you were to, for example, TECL, take a look at the technology index on the, I believe this is a 2X or 3X ETF. Take a look at this from a weekly standpoint. You have a stop level. You'd have to widen the stops a little bit. I'd likely put them right down near these lows over here. So probably a little below. That puts it at 24.45, maybe a little lower. Maybe down near these lows, 23, call it 23, 25, 23.30. And again, you would have a risk level of about 12% with an upside potential of about 72 to maybe 140%. I believe this is a very low risk setup. I believe what we're looking at right here is a very low risk setup for a small portion. Again, do not bet the farm on this. This is not a confirmed setup yet, but I believe there's a very solid opportunity setting up right now, and I would call it a time price disruption event. I believe we're setting up a massive disruption event right over here, possibly through the end of the year, maybe into January, February, March, first quarter, where technology rebounds, large caps continue to perform, consumers continue to engage, and we may see a very solid upward move in gold. Okay, we're just really that close to a major disruption event, something like right back over here where we saw this contraction, this consolidation, this big breakout. And what happened with the trend here is the SPY rallied about 14%. QQQ rallied from 2014-15 to 2017, about 55-60%. Gold set up a massive bottom and started to rally. This was a big move in gold from about 1,000 up to about 1,500. And I think we could do the same thing here from about 1,700 up to about 2,400, possibly over the next 5 to 12 months. All right, that's your special update for now. We'll see how this plays out. Remember, this is a dabbling of what I consider to be a very low-risk potential trade. If it fails, it's going to continue to engage lower. The Fed's going to continue to raise interest rates, and we're going to move into a recessionary type of trend. If it confirms, what we're going to see over the next 4 or 5 months is a decidedly upward trend in technology, large caps, QQQ, SPY, and the consumer index, as well as a very solid bottom in gold, likely moving up to the 1850, 1950 level fairly quickly by the end of the year. All right, there's your special update. Let's see how this plays out. And remember, this is more of an interpretive gut feeling about this. I'm seeing this upward trend here in the technology index. I'm seeing support in QQQ, SPY. We don't have any real solid confirmation, although the rotational modeling system is still bullish on the SPY. It is bearish on the QQQ. So we are seeing some upward opportunity here, but this is more of a technical trigger, a very low risk, in my opinion, technical trigger that may prove to be very, very timely. While everyone's expecting the markets to collapse on the Fed next week, I'm thinking this could be a very solid washout, fear, panic, low, setting up right away for the markets to move higher. All right, follow me on Twitter, follow me on YouTube. Big changes coming on my website, ment.com. Remember, go to ment.com and see what you can get for free. All of my research is free. Let's make this a great, successful end of the year, and let's get ready for what may become a fairly strong Christmas rally setting up.